I'm Antonio Cousin, and today I'm going to teach you the benefits of scaling into multifamily units instead of single-family houses. If you're still buying single-family houses to build wealth, you're playing a game that was designed to keep you busy, not rich. Most investors start with houses because they're safe, but I'm going to show you why staying in the single-family lane is the fastest way to hit a ceiling you can't break through. Today, I'm showing you how to scale from one door to hundreds. We're going to go beyond the basics and look at the math that proves why the government actually wants you to own an apartment building instead of a townhouse or a single family. Let's be real, managing 10 houses in 10 different neighborhoods means 10 different roofs that may leak or 10 different lawns to mow. Surprise, you played yourself. It's not an investment, it's a job you created by yourself, for yourself. When you have 10 separate assets, you have 10 points of failure. If one tenant leaves a house, your income for that asset goes to zero. You are now 100% vacant and paying the mortgage out of your own pocket. But there's a deeper issue called the velocity of money. To buy 10 houses, you have to do 10 inspections, 10 appraisals, 10 separate closings. That is 10 times the paperwork and 10 times the stress. In the multifamily world, we do all of that once and walk away with 10, 20, or 50 plus units. You aren't just scaling your portfolio, you're scaling your time. I want to take you even deeper because I talk to investors every single week who are exhausted, and if you can't figure out why. We got 6, 7, 8 houses. On paper, they look like they're crushing it, but in reality, they're drowning. Here's what nobody talks about in the single family game: the hidden tax on your time. Let me paint the picture for you. You got 8 houses spread across 3 different zip codes. House number 1, the heater dies in February. House number 3, the tenant breaks the lease and disappears. House number 5, the city just cited you for a property code violation on the fence. House number 7, the roof has been fine for 3 years, but your property manager just sent you a photo and now it's not fine anymore. None of these things are happening at the same time on purpose, but they always happen at the same time. That's just the law of single family ownership. And each one of those fires requires your attention, your decision making, your money, and your energy. Multiply that by 8 properties and you're not an investor, you're a firefighter. Now compare that to owning one 50-unit apartment complex. You've got one address, one management company, one insurance policy, one property tax bill, one roof, one set of systems. When something goes wrong, and something always goes wrong, you make one call, one decision, and you move on. The efficiency gap between those 2 scenarios is not incremental, it's generational. Let's also talk about vacancy because this is the number that keeps single family investors up all night. In a single family house, your vacancy rate is binary. The tenant is either there or they're not. You're either collecting 100% of the rent or you're collecting 0. And when you're running 10 houses, statistically, at any given point, 1 to 2 of them are going to be empty, being turned over or in some form of transition. That means you're consistently eating 10 to 20% vacancy across the portfolio, except it doesn't feel like 10 to 20%. It feels like a gut punch every time it happens because each empty house is a specific address you're now funding out of your pocket. In multifamily, vacancy is a percentage of a whole, and that changes everything. You got a 50-unit apartment building and 4 units are vacant, you're running an 8% vacancy. The other 46 units are still paying rent. Property is still cash flowing. The lights are still on, the mortgage is still covered. That's the resilience that single-family investors are desperately trying to replicate by buying more houses, but buying more houses doesn't solve the problem, it actually amplifies it. So the answer isn't more single-family, the answer is a better structure. And let's not forget about appreciation, the thing every single family investor is quietly banking on. You buy in a nice neighborhood, hold for 5 years, hope that the market goes up, and then you cash out. That's the plan, right? Here's the problem with that plan. It's passive. It's reactive. It requires you to wait. Waiting is a strategy for people who don't know how to create value on purpose. And I'm going to show you exactly how multifamily investors manufacture value on demand without waiting for a single comp to sell down the street. But before I get there, I need to talk to you about the opportunity that's sitting right in front of every investor in this country right now, because the market conditions are unlike anything we've seen in the past decade. Let's talk about what actually happens in the real estate market right now, because if you only watch the news, you think the sky is falling. Interest rates are elevated, prices are high, consumer confidence is shaky, and everyone is telling you to sit on the sidelines and wait. But here's what institutional money is doing. They're buying multifamily assets right now. Why? Because they understand something that the average retail investor doesn't. Housing demand in America is structural. It is not going away. Here are the numbers. The United States is short approximately 3.8 to 4 million housing units. We underbuilt after the 2008 financial crisis, and we never fully caught up. Single-family construction has been constrained by labor shortages, supply chain issues, and zoning restrictions. And meanwhile, the millennial generation the largest living generation in American history, is now fully in their prime during their household former years renting. What does that mean to you? It means demand for rental housing is not a trend, it is a demographic certainty. And when supply is short and demand is strong, rents go up. When rents go up, NOI, or net operating income, goes up as well. So when the NOI goes up, property values go up. It's a chain reaction, and multifamily investors are positioned to capture every single link up. So now let's talk about interest rates, because this is where most people's thinking gets completely backwards. Yes, rates are higher than they were in 2020 and even 2021. That's a fact. But here's another fact. Rates are exactly where the opportunity is right now. When rates were at 3%, every amateur with a Zillow app were buying properties, overpaying and driving cap rates into the ground. Don't worry about cap rates, I'll explain in a second. But the competition was insane. I'm a realtor, so I was making a lot of money and I enjoyed that period. But competition was insane. The margins were compressed. The deals were bad. Now, a lot of those over-leveraged buyers are underwater, and properties are coming back to the market. Sellers who were unrealistic a few years ago are now motivated. And if you know how to underwrite a deal correctly, if you understand how to buy on today's numbers and not on the hope that rates come back down, you can find assets right now that will be generational wealth plays, in my opinion. Here's my rule. Never buy a deal based on a rate you hope to have someday. Let me say that again. Never buy a deal based on a rate you hope to have someday. Buy the deal based on the rate you have today. If it cash flows at 7%, it'll absolutely cash flow at 5%. You're not guessing. You're locking in a margin of safety and playing the upside. That's not pessimism, that's discipline. And here's something else every smart money understands. In a high rate environment, fewer people can afford to buy a house, which means more people are renting, which is exactly what you want when you own apartment buildings. Rising rents are actually a tailwind for rental demand. The people who can't buy a home have to live somewhere, and they're going to show up at your property looking for a lease. So the narrative that the rates are bad for real estate investors is incomplete. It's bad for single-family flippers, it's bad for over-leveraged speculators, but for the disciplined multifamily operator who buys for cash flow and manages their assets well, it's one of the best markets in a generation. So here's a viral secret that no one tells you about houses. Their value is determined by the guy next door. If your neighbor sells his house for less than his worth, your house value drops too. You have zero control over that, nothing you can do. But in multifamily, the building is valued as a business. We determine value using a formula: net operating income divided by the cap rate. Net operating income is the total income generated by the property subtracted by all of the expenses, not including the debt. The cap rate is the expected annual return on an unlevered income producing property. What does that mean? That's if you didn't have a loan, the cap rate would be the expected return on the income producing property that purchased with 100% cash. The deep dive, let's look at the math. If I find a way to add a, let's say $50 pet fee per unit on a 50 unit building, that's an extra $30,000 a year in income. Off of $50, $30,000 difference in income. That $50 times 50 equals $2,500. Times 12 months, that's how I got to the $30,000 per year. So in a 6% cap rate market, that simple $50 per unit just shifted my asset and added value by $500,000 to the value of the property. You didn't wait for the market to go up. You forced it to go up. That is how you manufacture wealth on demand. Now let me expand on this, because the example barely scratches the surface of what a skilled operator can do to force appreciation in a multifamily asset. Let's talk about the full toolkit. Because value add in multifamily isn't just about raising rents, it's about identifying every single revenue line and expense line on that property and asking, can I improve this? On the revenue side, you've got your base rent, that's the obvious one. But then you got ancillary income. That is where things get really interesting. So let me walk you through an example of that same 50 unit building. You add a $50 pet fee, that's $30,000 per year in that new income that we discussed previously. Now you add a covered parking for, let's say, $75 a month per spot. If you can convert 30 spots into covered or reserved parking, that's $75 times 30 equals $2,250 per month. Times 12, that equals $27,000 per year. At a 6% cap rate, that's another $450,000 added to the value of the building. You haven't renovated a single unit. You paved the parking lot and put up some reserve signs. Let's say you add a coin-operated or app-based laundry to the building. Let's say you bring in $400 a month net from the laundry room. That's another $4,800 per year. At a 6% cap rate, that's $80,000 in added value from the laundry room. Now let's say you go unit by unit and raise rents by $150 per month across all 50 units through a renovation program. You got new flooring, new cabinets, Updated fixtures, that's $150 times 50 equals $7,500 per month. In new income times 12, that equals $90,000 per year. At a 6% cap rate, that's $1.5 million in forced appreciation from a cosmetic renovation budget. Add it all up, you got the pet fees, the parking, the laundry, and then the rent bumps. You've added roughly $2 million in value to a building in 18 to 24 months. Not because the market moved, but because you ran the property like a business. Show me a single family house where you could do that. You can't. You're at the mercy of the neighborhood. In multifamily, you are the neighborhood. You set the standard. Now let me talk about the expense side, because forced appreciation isn't only about increasing income, it's also about tightening expenses. And this is where most value add operators leave serious money on the table. The biggest expense line item in most apartment buildings, after the mortgage of course, is the utilities. In many older properties, the landlord is paying for water, gas, or electricity on behalf of the tenants. That is a direct drag on your net operating income, and it's also a tenant behavior problem. When someone else pays the water bill, nobody's turning off that faucet. The solution is RUBS, R-U-B-S. It stands for Ratio Utility Billing System. You implement a formula that allocates the utility cost back to the tenants based on occupancy or unit size. You're not necessarily charging market rates for utilities, you're just shifting the cost from the landlord to the resident. The shift alone on a 50-unit apartment building, as we'll keep on with this example, can save you $30,000 to $50,000 a year in operating expenses. And what happens when you cut, let's say, $40,000 in expenses? Your NOI goes up by $40,000, which means at a 6% cap rate, that's another $666,000 in value without touching a single unit. So this is the multifamily operator mindset. Every decision you make, whether to spend or not to spend, whether to raise the rent or add a fee, it all flows through the NOI formula and directly into the value of the asset. You are consistently, actively, intentionally building equity. That's not what's happening when you own houses. When you own houses, you're just hoping. All right, I want to shift gears for a minute, because I talk a lot about people who want to get into multifamily, but they don't know how to evaluate a deal. They see a listing, it looks good on the surface, and they want to jump. And that's how you lose money. So let me walk you through the core metrics every multifamily investor needs to understand. And I'm going to break this down in plain English, not MBA speak. The first metric is the cap rate. We already touched on it, but let's go deeper. The cap rate tells you what return the property generates before debt service, assuming you paid all cash. It's a snapshot of the asset's performance in relation to the market. A 4% cap rate means the property is expensive relative to its income. You're paying a premium, usually for a location or quality. So you usually see these on, the more desirable areas of the newer property. An 8% cap rate means the property generates more income relative to its price, potentially a better value, but often in a less desirable market or in a worse condition. So here's the key. Cap rates, they're a market tool, not a personal finance tool. They tell you how the market values the asset. Your job as an investor is to buy at one cap rate and force the property up to a higher effective yield through your operations. That spread between your purchase cap rate and your exit cap rate is where a significant portion of your return comes from. The second metric is the cash on cash return. This one is specifically about your actual cash invested versus the actual cash you get back each year after paying the mortgage. Say you put $500,000 down on the property, and then after all expenses and after paying the debt service on the property nets you $50,000 per year in cash flow. Your cash on cash return is 10%. $50,000 divided by $500,000 down, that's how you get the 10%. That's it. Simple. How many dollars did I put in? How many dollars am I getting back? That's the number. For most markets, a 6 to 8% cash on cash return is considered solid. Anything above 10% in a good market is exceptional and worth taking a very close look at. Anything below 5%, and you need to ask why you're pulling capital to work at the return when there are better alternatives. The third metric, and this one is a little more difficult to calculate, so I'm not even going to try to explain the formula to you, but it's called the internal rate of return. Sometimes you'll see it as IRR. This is the big picture number. It accounts for all your cash flow over the holding period, your equity at the exit, and the time value of money. So I would recommend you use a financial calculator to calculate this, because the formula itself is really difficult. If you hold the property for 5 years, the IRR tells you the annualized return on your total investment over the full period. In a well-executed value-add deal, you're talking about 15 to 20% IRR That's what separates a good deal from a great one. And understanding the IRR is crucial if you're investing in a syndication, because that's the number the operators will use when they try to pitch you to, get your money, get your capital invested in the deal. So you need to know how to stress test it. What assumptions are built in, and what happens to the IRR if rents don't grow as projected, or if the exit cap rate is higher than expected. Now, let me talk about what the numbers look like on a real deal. And I'm going to give you the red flags too, because knowing when to walk away is just as important when knowing when to buy. Green flags: the in-place rents are significantly below market. The current owner hasn't raised rents in maybe 3 to 5 years. The expense ratio is over 55%, meaning the expenses are eating more than 55 cents on every revenue dollar, which signals mismanagement you can fix. The property is in the market with strong growth and population trends. The seller is motivated. That's a definite green flag and something you should look more into, as opposed to a red flag. Let's say the seller is presenting you with pro forma numbers, meaning they're putting their projections into the numbers that they're presenting to you, rather than the trailing 12 months of actual performance of that asset. There is significant deferred maintenance that isn't reflected in the asking price. The market is shrinking, the jobs are leaving, population is declining, new supply is coming online, cap rate is already compressed with no clear path to add value. And the biggest red flag of all, the deal only works on paper if you assume aggressive rent growth and a lower exit cap rate. That's not underwriting, y'all. That's speculation. A real deal works on day one. The upside is gravy. Never fall in love with a deal you have to talk yourself into. The numbers either work or they don't. Now let me switch gears for a second. The IRS isn't your enemy if you're a multifamily investor. In fact, they're your partner. Why? Because the government needs people to provide housing. Under the current rules, we have permanent 100% bonus depreciation. This is a game changer for high earners. Through a cost segregation study, we can identify parts of the building like the flooring, lighting, landscaping, and accelerate their depreciation. Instead of waiting 27.5 years to write them off, you can write off a massive chunk in year one. This allows you to take paper losses on your tax return to offset your other income. This is how the wealthy legally pay $0 in taxes while their bank accounts grow by millions. You're using the government's own rule book to fund your next deal. I really need you to look into that. Rewind it if you need to, but this is very key, very important. Don't overlook it. I have a separate video on my channel breaking down how depreciation works if you want to get into the weeds. But let me give you a little more context here, because the tax advantages of multifamily go well beyond bonus depreciation, and I want you to understand the full picture. Let's start with real estate professional status, or sometimes you'll hear people say REPS, R-E-P-S. Under the tax code, if you or your spouse materially participate in real estate activities for more than 750 hours per year, and that activity represents more than half of your total working hours, you can qualify as a real estate professional. What does that unlock? It means that your real estate losses are no longer passive losses. They become active losses that you can use to offset any type of income, including your W-2 salary, your business income, your investment income, all of it. I recommend you get with a CPA and discuss that in more detail. I'm not a financial advisor. I'm not a CPA. I'm just giving you the game. It's up to you on what you do with it. So think about what that means in practice. Let's say, let me give you an example. Let's say you're a physician and you're making maybe $400,000 a year. You own a 30-unit apartment complex. You do a cost segregation study that generates $300,000 in paper losses in year one of owning the asset. If you or your spouse qualify as a real estate professional, you can potentially apply that $300,000 loss directly against your $400,000 in income. Your taxable income basically just went from $400,000 to $100,000. You just legally saved somewhere between $80,000 to $120,000 in federal income taxes, just based on what tax bracket you're in 1 year, guys, in 1 year, from one property. Using depreciation on the asset that is simultaneously appreciating in value. That's the magic. That's how you do it. This is not a loophole either. That is the tax code working exactly as Congress intended. The government wants private investors to provide housing, and they built the incentive structure accordingly. Now let's talk about the 1031 exchange, because this is the strategy that lets you compound wealth across multiple generations without ever triggering a capital gains event. You buy a property, you add value to that property, and you hold it for a few years. And then you know what? It's time to sell. Normally the sale would trigger a capital gains tax on your profit, potentially 20% or more. All right, depending on your income. But if you reinvest the proceeds into a like-kind property within the rules of section 1031 of the tax code, you can defer the tax entirely. So instead of writing a check to the IRS, you take 100% of your sale proceeds and you roll them into the next larger deal. You're not just building equity, you're compounding equity without the government taking a cut at every step. The rich have been doing this for hundreds of years. It's not a secret, it's a choice. And here's the ultimate move. You do a 1031 exchange throughout your lifetime, building a larger and larger portfolio, accumulating more and more depreciation, and passing the portfolio to your heirs at your death. When they inherit the properties, they receive what's called a step up in basis, meaning all of the deferred capital gains taxes is wiped out entirely. So you never pay taxes on the amount that you should have paid years ago. That tax liability, it just disappears. I have a video on my channel. If you want to go look up the depreciation and the step up in basis, I break it down in detail. So your kids are basically inheriting the wealth without the tax bill. So that is a generational wealth strategy executed at the highest level. Now, how do you actually get into these 50 unit deals? We've been talking about it for the past few minutes. Most people think that they need $5 million in the bank, but you don't. There are two main ways to do this: syndications and joint ventures. In a syndication, you're a passive investor. You bring the capital, and an experienced operator handles the deals, the management, and the renovations. You get a piece of the pie without the 2 a.m. phone calls. Before jumping into one of these, you must understand that you're putting your money into a project that will be tied up until the property is either sold or refinanced. In addition, you have to vet the sponsor, as you're betting that they will do right with your money. In a joint venture, on the other hand, you're more active. So you and a few partners go in together, each bringing a specific skill or resource. The key is to stop thinking you have to do it alone. In multifamily, real estate is a team sport. Let me give you a little more detail on both of these, starting with the syndications, because this is how most new multifamily investors get their first real exposure to large assets without needing to be the operator. This is actually how I started. So a syndication is essentially a group investment structure. You have the general partner or the GP. That's the operator, the person running the deal. And then you have limited partners or LPs. Those are the passive investors, just putting up capital. That was me. The GP finds the deal, they negotiate the purchase, they arrange the finances, they manage the renovation and the property. They basically execute their business plan. The LPs, all they're doing is writing a check and collecting distribution. The typical structure is gonna look something like this. The LP, they'll get a preferred return, usually somewhere between 6 and 8% annually before the GP takes any profit. Then once the preferred return is paid, the remaining profits are split between the LP and the GP at some ratio. Commonly, you'll see 70-30 or 80-20 in favor of the limited partner. When the property is sold or refinanced, everyone gets their proportional share of the equity. So as an LP, what are you actually investing in? You're invested in the operator's track record and their team, also their market knowledge and their ability to execute the business plan. This is why vetting the sponsor is absolutely critical. You need to ask things like, how many deals have they done? What were the actual returns versus the projected return? How did they perform when things went wrong? Because things always go wrong. The question is, how does the operator handle it? If you want, you can email me. I have a list of questions that you can ask the operator. It's a ton of questions. Or you can also throw it in maybe ChatGPT or some other AI tool. It'll give you a list of questions you should ask any operator or general partner prior to going into a deal with them. The right sponsor, they're going to communicate proactively, especially when they're a problem. They're not hiding behind bad news until a quarterly report. They're calling you, explaining what happened, and telling you their plan to fix it. The wrong sponsor, they're gonna go quiet when the deal gets hard. Know the difference before you write that check though. Now, let's talk about what your first few years in a syndication actually looks like as a limited partner. Year 1, the operator is likely in acquisition mode and then renovation mode. So cash distributions may be light or non-existent when the business plan is being executed. That's normal. You're not in this for the monthly check. You're in it for the total return over the whole period. Now, years 2 and 3, the value add work is complete. The units are renovated, rents are raised, and then the property is stabilized. The cash flow is going to increase. You start receiving the regular distributions. The property is worth significantly more than what it was when you purchased it. Year 4 or 5, the operator executes the exit. The property is refinanced or sold. You get your equity back plus your share of the appreciation. If the deal was underwritten correctly and executed well, your total return, combining your cash flow and your equity, puts you well above what the stock market would have returned over that same period. And here's the thing, while all of this was happening, you were doing absolutely nothing. Exactly nothing. You wrote a check, you reviewed quarterly reports, and you collected distributions. That is what passive really means. Not less work, no work. Now, on the joint venture side, this is the path for the investor who wants to be more active. You want to learn the business from the inside and want to build on your track record. A joint venture is a partnership agreement between two or more parties, each contributing something specific. Maybe you bring the capital, but not the experience. You partner with someone who has the experience in the deal flow but needs a capital partner, or you bring the deal finding and underwriting skills and your partner brings the construction management expertise, or you bring both and your partner just brings a network of investors. There's a ton of ways to do this, but the key things are you have to contribute something and they have to contribute something. But the key to a successful JV is clearly defined roles before the deal closes. Who is the asset manager? Who is the property manager? Who signs on the loan? Who makes the final call in the disagreement? These are not the conversations you want to have for the first time in the middle of a renovation when tensions are high and money is on the line. Get all of that in writing up front. Get an attorney involved. Structure the entity properly. The most successful JV partnerships I've seen are the ones where each partner has a genuine skill that the other lacks, and where both partners are completely clear on what winning looks like before they start. Don't partner with people just because they're your friends. Partner with people because their strengths fill your gaps. That's business, and multifamily is a business. Now let's talk about money, because this is where most people hit a wall. They see a $3 million apartment building and they think, I don't have $3 million, so this isn't for me. That thinking is exactly what keeps most people out of the game. In multifamily, you will both never fund a deal with your own money. That's not how it works. What you're managing is a capital stack, layers of financing from different sources, each with a different risk profile and a different cost. At the bottom of the stack, you've got senior debt. This is going to be your primary loan. For properties with 5 or more units, this is what's called a commercial loan, not a residential mortgage. And this distinction matters enormously. Commercial loans are underwritten based on the property's income, not your personal income. The lender looks at what's called the DSCR, debt service coverage ratio. Most lenders want to see a DSCR of at least 1.25, which means the property's net operating income needs to be at least 1.25 times the annual debt payment. So here's the math. If your annual debt service, that's the principal plus interest, is let's say $200,000 per year, the property needs to generate at least $250,000 in net operating income to qualify. Why does this matter? Because it means as you increase NOI through your value add strategy, you also improve your ability to refinance the property at a higher loan amount, pulling out tax-free equity while selling the asset. That's the BRRRR strategy applied to multifamily, and we'll talk about that in a second. For larger apartment communities, you've got access to what's called agency debt, loans backed by Fannie Mae and Freddie Mac. Those are some of the best financing terms in commercial real estate. You got lower interest rates, longer amortization periods, and higher loan-to-value ratios than typical bank loans. The trade-off is that the underwriting is rigorous and the property needs to be stabilized, typically above 90% occupancy for a period of time. That's what's considered to be stabilized. If you're buying a value add property that's currently, let's say, 70% occupied because the previous owner was mismanaging it, you're not going to qualify for agency debt on day one. You'll use what's called bridge financing, which is a short-term loan. Typically, you're looking at 12 to 36 months. It's going to fund the acquisition and the renovation. The terms are more expensive, but they're designed for exactly for this situation. Buy the asset at a below market performance, you execute your business plan, the occupancy up, and then you refinance into agency debt once the property is stabilized. The refinance is going to be your moment of truth. If you've done the value add correctly, the property is now appraised at a significantly higher value. Your new loan is larger, you pull out cash, tax-free, because debt is not income, and you use the capital to fund your next deal. You basically recycled your equity. You compound it without a taxable event. That's the flywheel. Now let's talk about the BRRRR strategy. That's the BRRRR strategy in the multifamily context, because I know a lot of people have heard this term applied to single family, but the multifamily version is where the real leverage is. BRRRR stands for buy, rehab, rent, refinance, and repeat. Here's how it works at scale. Now I'm gonna use a lot of numbers here, so do your best to keep up with me. All right, you find a 30-unit apartment building that's mismanaged. The rents are $200 below market. Half the units need cosmetic updates. The current owner is burned out and motivated to sell. You negotiate a below market purchase price, let's say $2 million, using bridge financing with 25% down. So that 25% represents $500,000 of your own capital. Over 18 months, you renovate the units, you raise the rents to market, you push occupancy up to 95%, and you optimize the expenses. Now the NOI has gone from $100,000 per year when you bought it to $180,000 per year after your improvements. Now you go to refinance. At a 6% cap rate, a property generating $180,000 in NOI is worth $3 million. Basically, I took that $180,000 divided by 6% cap rate. That equals $3 million. Your new agency loan at 75% loan to value gives you $2.25 million. So you pay off your $1,500,000 bridge loan and you've recovered $750,000 from the refinance. That's basically the difference between the loan at 2.25 minus the 1.5 bridge loan. So you recovered $750,000 from the refinance. You initially put in $500,000 out of your own pocket. So you not only gotten your money back, you've also gotten an additional $250,000 profit, and you still own the building. So now you have none of your own money in the building, you have a loan on it, and you've recovered an additional $250,000 profit. And guess what? The building is now cash flowing at a higher rate, and you got the capital to do it again. Not only that, the $250,000 is not taxed because it's a loan. Remember, you never pay taxes on a loan. This is the strategy, folks. This is what the wealthy have been doing for years. Now it's your turn to implement it. That's the machine. Once you understand how it works and you've run it once, the second deal gets easier. The third deal gets easier than that. The portfolio compounds on itself. And finally, I want to mention seller financing, because in the current interest rate environment, this is a strategy that is making a real comeback. Seller financing basically means instead of going to the bank for your loan, the seller for the property acts as the bank. They carry the note, you pay them directly on terms you negotiate. For the seller, it's a way to generate ongoing income, spread out the capital gains tax, and often get a higher price than they would for an all-cash deal. For you, it's a way to bypass the bank, potentially getting a more favorable interest rate and close fast. Now, every seller won't want to do this, but motivated sellers, particularly the ones who own their property free and clear or who have a small remaining loan balance, are often open to the conversation. If you're not asking, you're leaving options on the table. So I want to address something that I see holding a lot of investors back, especially the ones who are successful in their careers and used to doing everything themselves. The idea that they can figure out multifamily on their own, maybe read a few books, watch enough videos, take enough courses, and then go out there and buy a building solo. And I'm telling you, that's not the path. Not because you're not smart enough, you are, but because the transaction cost of learning every role in real estate investing by yourself in real time with real money on the line are enormous. The mistakes are expensive, the learning curve is steep, and there are people who already know what you need to know, but you can put on a team right now. Your team is not overhead. It's not. Your team is your competitive advantage. Let me say that again. Your team is not overhead. Let me say that again. Your team is not overhead. Your team is your competitive advantage. Let's start with your CPA. And I'm not talking about a tax preparer who does your W-2 returns every April. I'm talking about a CPA who specializes in working with real estate investors. This person should be talking to you 3 or 4 times per year, not just at tax time. They should understand cost segregation, real estate professional status, 1031 exchanges, entity structuring, all of it. And if your current accountant looks at you blankly when you say bonus depreciation, it's time to find a new accountant. The cost of a great real estate CPA is trivial compared to what they save you. We're talking about potentially tens of thousands of dollars per year in tax savings. And they pay for themselves many times over on the first deal. Next, your attorney. You need a real estate attorney who understands commercial transactions and entity structuring. Every deal you do should be held in its own entity, typically a limited liability company, to protect your personal assets. I'm not a tax attorney. I'm not a real estate attorney. I'm just telling you what I know. Your attorney is basically going to set that up correctly. They're going to review your purchase agreements and protect you in the due diligence process. Don't sign a purchase contract without legal counsel. The seller's attorney is not on your side either. So let's talk about your commercial real estate broker. Kind of know a guy. This is different from a residential realtor. A commercial broker who specializes in multifamily has access to off-market deals. They know the submarket inside and out and understand the nuances of commercial underwriting. They can also provide you with comparable sales data you need to validate your assumptions. Build a relationship with 2 or 3 good brokers in your target market. Tell them exactly what you're looking for. Let them know you're a serious buyer who can close. The best off-market deals go to investors the brokers know and trust, not whoever posts on LoopNet first. Not a shot at LoopNet. Your property management company is arguably going to be your most important relationship on an ongoing basis. This is the team that will execute your business plan on a day-to-day basis. They collect rent, they handle maintenance requests, they manage tenant relationships, enforce lease terms, and handle the turnover process. So a great property management company makes your life easier. Trust me. A bad one will quietly destroy your investment while sending you optimistic monthly reports. Now, how do you find a great one? Referrals from other investors in the market is probably going to be your best resource there. Talk to investors in their current portfolio if they're willing to share. Ask about vacancy rates, delinquency rates, maintenance response times, and reporting quality. Look at how they handle evictions. Look at how they communicate when problems arise, and interview at least 3 before you decide. And finally, your contractor network. Ideally, your property manager should have some referrals for you here, but if they don't, that's okay. You might want to go out and interview for your own. If you're buying value-added assets, you need reliable contracts who understand renovation timelines and budgets in the multifamily context. Residential contractors, your typical home remodeler, often don't scale well when you have 30 to 50 units. You need someone who can run simultaneous crews amongst multiple units, hit their timelines, and stay within budget. Building this relationship before you buy is critical. Get your unit turn cost estimates before you close. Walk the property with your contractor, not just your inspector. Know your renovation budget with precision, not guesswork. Your team, so that's your CPA, attorney, broker, property manager, and contractor. That's the roster. Build it early. These relationships take time to develop, and the best professionals are selective about who they work with. So get in front of them before you need them, not the day after you're under contract. I watched a lot of people come into the multifamily space full of energy and excitement, make 1 or 2 specific mistakes, and set themselves back years. So I want to talk about those mistakes right now because avoiding them is worth more than the strategy I can give you. So the first and common mistake, overpaying for the deal. And I don't just mean offering too much at a purchase. I mean buying a deal at a price that requires everything to go right. Buying a deal at the price that requires everything to go right. You heard me. Rents have to grow at the rate you projected. The renovation has to come in at budget, which it rarely does. And you have to exit at a cap rate you assume. And if any single one of those assumptions is wrong, the deal doesn't work. The fix is simple, but uncomfortable. Underwrite conservatively. Stress test your assumptions. What happens if rents grow half as fast as you projected? What happens if the renovation costs exceed 15% than you budgeted? What happens if cap rates expand by 50 basis points when you go to sell? Does the deal still work? If it falls apart under stress, it's not a good deal. Walk away. The next deal is coming. The second mistake I see is buying in the wrong market. This is especially common among investors who buy close to home out of comfort without actually analyzing whether the market supports the investment thesis. The best multifamily markets share a few characteristics. They have population growth. People are moving in, not out. They have economic diversity. The job base isn't dependent on one employer or one particular industry. They have landlord-friendly legal environment. Eviction timelines are reasonable. Rent control laws are limited. They have a shortage of rental supply relative to the demand. And they have rent growth trends that support your underwriting. The worst markets are the inverse of all of those. High rent control, shrinking population, single employee economies, oversupply of new construction. If you're buying in a market just because it's nearby, you're making a lifestyle decision, not an investment decision. Know the difference. The third mistake, being undercapitalized. This is one of the things that kills deals that were otherwise good. You close on the property, you start the renovation, and 3 months in, you hit unexpected structural issues. A plumbing system that needs full replacement, asbestos remediation, or a roof that's worse than the inspection showed, and you don't have the reserves to handle it. Every deal should be closed with a capital reserve. The typical rule of thumb is 3 to 6 months of operating expenses held in a reserve, plus a contingency on top of your renovation budget, typically 10 to 15%. This money should be in account on day one. It's not the fund money, it's the insurance policy. And if you never need to touch it, you'll return it to your investors or use it to fund the next deal. But if you don't have it and you need it, you're in a crisis. So the fourth mistake, poor tenant screening. This one is operational, not strategic, but it will absolutely destroy your cash flow. If you don't take it seriously, one bad tenant can cost you 3 to 5 months of rent between unpaid rent, legal fees, and the cost to turn the unit after they leave. Multiply that across a portfolio and you understand why the best property managers treat their screening process like a science. Income verification, credit checks, rental history, criminal background checks. These aren't optional steps. They're the foundation of your business, and the pressure to fill vacant units quickly is real. But a bad tenant is always more expensive than a vacant unit, always. The fifth and final mistake I'll cover today is making emotional decisions. This happens 2 ways. First, you fall in love with a property and override your underwriting to make the deal work. I almost did that recently, actually. The numbers don't really pencil, but you want to make it work, so you massage the projections until it looks like it does. This is called deal fever, and it's a financial disease. The second way is the opposite. You get scared, the market feels uncertain, rates are high, a deal falls through, and you freeze. You stop looking, you stop making offers, and while you're frozen, the deals keep happening just without you. The investors who build real portfolios are the ones who stay disciplined in their underwriting and stay active in their deal flow. regardless of how the market feels on any given day. The market always feels uncertain when you're in it. The investors who build wealth are the ones who make decisions anyway, informed, disciplined decisions, while everyone else is waiting for certainty that will never come. So you don't need to be a billionaire to start. You can start by house hacking a duplex or a fourplex, or you can partner with people who have already had the systems in place. The key is to stop thinking in houses and start thinking in doors. The more doors under one roof, the more freedom you have. Look, the transition from single family to multifamily isn't just about math, it's about a mindset shift. Most people will watch this video and go right back to scrolling, but the ones who actually build wealth are the ones who keep feeding their brain with the right strategies. And here's the last thing I want to leave you with. Wealth in real estate is not built in single transactions. It's built in systems. The investor who builds the right team, the right underwriting discipline, the right market knowledge, and the right operator relationship, and then applies those systems repeatedly, patiently over time, that's the investor that wins. Not the one who hit a lucky flip in a hot market, not the one who timed the rate cycle perfectly. It's the one with the systems. The single family investor is building one house at a time. The multifamily investor is building a system, and systems scale. Houses do not. You've been listening to me lay out the full picture today. The management inefficiency of a single family, the structural demand in the rental market, how to force appreciation through the NOI formula, the tax advantages that the multifamily structure unlocks, how to get into deals through syndications and joint ventures, how to finance and structure those deals, how to build a team around you, and how to avoid the mistakes that take otherwise good investors. The information is all there. The question is, what will you do with it? If you found value in this breakdown, I'm dropping deep dives on exactly how we're finding these deals, cutting taxes, and building true passive income in today's market. Hit that subscribe button and turn on the notification bell so that you don't miss the next strategy session. I'm Antonio Cousin. Thanks for watching, and I'll see you in the next video.